Hey guys, so today I'm giving you my complete beginner guide on how to invest in the stock market and why it's the best way to make money in 2021. I know that it's a long video, but if your goals are as simple as wanting to make educated investment decisions to as lofty as wanting to transform your life and gain financial freedom, then this free course is the only blueprint that you need. Today, I'll be giving you a comprehensive guide on how to get started in the stock market. The first thing I'll be covering is the definition of a stock and how the stock market works. We'll also talk about the difference between trading and investing and which one is more tailored to you. Next, we'll talk about one of the most crucial aspects, which deals with the unique mindset that it takes while investing, as well as common mental barriers that prevent people from realizing their full potential in the markets. I'll share the rules I have followed and the mental barriers that I've had to overcome to be successful. Then I'll show you the easiest way to open up a brokerage account. I'll show you some of my favorite platforms that I use and how to set up an account that aligns with your investment plan. Next, I'll cover everything you need to know when researching the companies that you'll be investing in. I'll be giving you a brief overview on how to evaluate a company's numbers and the most important things to look for. Then I'll teach you how to analyze price action on the charts to catch explosive moves before most other people do. Next, I'll show you what it means to prospect and how much money to allocate to unproven companies with massive potential. We'll then cover the basics on how you can buy and sell stocks on Robinhood, which is the easiest brokerage to learn for a beginner. I'll also walk you through how much money you should be investing via a questionnaire that will give you guidance based on your current financial situation. Lastly, I'll touch on tax considerations because whether you sell a stock for a profit or for a loss, there are tax implications that are associated with it. I'm really excited to share my blueprint of how you can get started in the stock market today. Hopefully, by the end of this video, you'll be motivated to open your brokerage account and have the confidence you need to start your investing journey. Anyways, before we get started, I wanted to share a little bit about myself. My name is Isaac, and I started investing in the stock market in 2016, so it's been about 5 years now. I also create a lot of content on YouTube, and on my channel I give stock recommendations and teach how to assess companies and how to use powerful tools to predict market movements. Through my experience, I've realized how investing is such a great way to make money passively and grow your money long term. I'm a huge proponent of using the stock market to build wealth for anyone, so my goal is to give you all a foolproof method to making money in the stock market year in and year out. So if you're ready to get started, I want you to go ahead and click that like button and subscribe to the channel. Also, make sure to click that bell icon so that you get notified every time I post a new video. Some of my videos, such as my monthly stock picks and market updates, are time sensitive, so you definitely won't want to miss them. Alright family, enough with the me talk. Let's start talking about how I can help you to make money. Your first question might be, well, why should I invest my money? Let's look at the average rate of return in the stock market. On this chart, we see that over the last 90 years, the average rate of return on the S&P 500, which is an index of the 500 big companies in the United States, is roughly 10% annually. Obviously, individual stocks can outperform the S&P 500, but my purpose in doing this is to show an average rate of return of the stock market as opposed to other main investments such as real estate. Now, this is historical data, and the assumption shouldn't be that the stock market will continue ramping up every single year. Looking at this chart of the S&P 500 returns on a year-by-year basis, we can see that some years had 20 to 30% returns, while other years had 10 to 20% decreases in the markets. However, we can conclude that over a long period of time, the markets will continue to go up. For example, even after the stock market had a major dip in March of 2020, we can see that it absolutely went on a tear since then. Investing in the stock market is one of the best ways to make money passively, and with just a little work, you can put your money to use instead of letting it sit around in the bank. This brings me to my second reason of why you should invest in stock. Investing in stocks is a hedge against inflation, which on average is 2 to 3% per year. Having your money sit in a savings account accruing a fraction of a percent annually means that you're actually losing money. So that's the point of investing. You're putting your money to work in the long term while letting it grow passively. So what are stocks and what is the stock exchange? Let's go over the definition of a stock. A stock is a piece of ownership of a company. A share is a unit of stock, so when you invest in a stock, you are buying shares. And companies raise capital by selling shares to the public through an IPO or initial public offering. This lets the company sell shares to people like you and I. As the shareholder, you are able to own a slice of the company. For example, if you own 6 shares of a company with 12 outstanding shares, you would have a 50% ownership stake in it. If a company does well and has really good earnings, the price of the stock will increase and you will make money as a shareholder in that company. Through fundamental analysis, which I will touch on later in this video, you'll be able to look at the numbers of a company, which can show you the health of a company while looking at various metrics such as the profitability of the company and whether its current stock price reflects its true value. Now we come to the stock exchange. What is it? Picture it as a marketplace where you can buy and sell stocks, bonds, and securities. One of the largest is the New York Stock Exchange, and companies like Apple and Google can be traded here. I'm sure you've seen media depicting stock exchanges as large rooms filled with people yelling out their orders, and to an extent that is true, but today's stock exchanges are mostly virtual. Stock exchanges are highly regulated, and the SEC, or Securities and Exchange Commission, has oversight over them. This is beneficial to you, the investor, because it prevents fraud by ensuring the transparency of earnings reports and security pricing. So I want to briefly touch on the difference between trading and investing. Ultimately, they are both methods of taking profits from the stock market, but what sets them apart is the length of time and the amount of return. Typically, investors will buy and hold shares based on the long-term trajectory of the company with larger anticipated returns. Traders, on the other hand, will buy shares and either hold them for the day, or what is called day trading, or for several weeks or months with the goal of taking smaller, more frequent profits. So which type works best for you? Long-term investing is good for those who want to make a more passive approach to the stock market, and this is what this video is geared to helping you master. This means that you're fine letting your money sit in the market for a long time while compounding interest. This is by far the safest method, as volatility in the stock market, such as corrections or crashes such as the one in March 2020, won't do much to impact the long-term trajectory of your holdings. Holding shares long-term also has the potential for huge rewards. For example, imagine buying Amazon at the beginning of the decade, which has increased by 1,250%, or Domino's, which has increased by 3,000%. Investing long-term also carries tax advantages, which I will cover at the end of this video. Some of the cons to long-term investing is that growth can be slower, it can be boring at times, and investments into an account such as a Roth IRA can't be withdrawn until you are 59 or about to retire. Trading, however, is good for those who want to make daily and weekly money and realize their profits in a much shorter time frame. The cons of trading is that it is much riskier than long-term investing, and it can definitely be more stressful and even addicting. Another con is that you'll end up paying higher taxes. Emotions play a major role when trading, and you will learn a lot about yourself and your emotional state when day trading. If your goals are to make money quickly, and if you treat the stock markets as a way to subsidize your income, then this next section where I talk about mindset is especially for you. However, these important lessons on mindset not only apply to those trying to play the markets faster, but even more so to investors. I've seen countless family members and acquaintances lose money even though they claim to be investing in a certain company or crypto for the next several years. When you see red in your trading account, it can really mess with you, so having the tools to put you in the right frame of mind is so important. Now, when I was trading early on, I approached the stock market with a gambling mentality. I lost 5 figures in the span of a few weeks, but that loss taught me some really valuable lessons on what mindset I had to take when I approached the market. The stock market will play on your emotions, scarcity mindset, and your fears. Oftentimes, you'll see a stock blowing up by 50-60% in a day, and you'll get this fear that a stock is running off without you. Then you'll enter a trade while the price of the stock is sky high in hopes of selling it higher. This is one of the riskiest and most dangerous ways to play. Other times, the market will mess with you. For example, there may be a negative news that comes out about a stock. However, you know that the fundamentals of the company are sound and that your charting, which I'll touch on later when I talk about technical analysis of a stock, is on point. Sometimes negative news coverages may come out about a stock to help drive the price down so that institutions can get a cheaper price and drive it right back up. And I'm giving you these examples to show you how volatile the market is and how much you need to have a lot of discipline. Obviously, the shorter your trajectory is on a stock, the more disciplined you have to be, and you have to stick with your investment plan, such as what percentage you'll take profits at or what percentage you'll cut your losses. One of the most important things to realize about the markets is that anything can happen. Every single price action or movement of the stock is unique from one day to another. Doing your own due diligence on the stock, such as keeping up to date with news, earnings, and also charting your stocks, will help you to give you an advantage. But since nothing is guaranteed in the market, all you can do is buy and sell on your advantage while also having plans in place if the price action of a stock does not move in the direction that you anticipate it to. In order to help you guys, I want to share some of the rules that I followed, and if you all follow these rules, I guarantee that you will crack that mental barrier that causes most people to lose in the stock market. The first one I've alluded to before is to not buy high in hopes of trying to sell higher. You always want to buy low and sell high. Don't worry about those stocks that run off without you, because the odds of you being profitable while buying high and selling higher are not in your favor. Let's take Tesla for example. I had friends who were all aboard the Tesla hype train and who bought in at $800 plus. At the time, there seemed to be this sentiment that Tesla couldn't go any lower and that it was headed to the moon. However, if they had taken the time to look at the charts and balance sheet, they would have realized that the price to earnings ratio was far from ideal and that the rapid price action upwards had created gaps that needed to be filled. Don't worry about the technical terms for the time being, as I've covered these topics in prior videos and they are linked above. But anyways, my point is that doing your due diligence and studying up on stocks that you choose to trade or invest in will save you from making a lot of mistakes and will increase your odds of being profitable in the market. The second rule is to never put all your eggs in one basket and to average into your position. Like I said earlier, the stock market is volatile. Just because you may think you know where a stock is headed doesn't necessarily mean that it will make its move immediately. It's important to scale into your position, especially when investing for the long term and placing longer term trades. And what I mean by that is, let's say you have $300 to invest in a stock. I will want you to split up that money into thirds and invest $100 at a time. Let's say you're bullish on a stock or that you expect the stock to go up in the long term. I will buy $100 worth of the stock and wait a few days. If the price of the stock moves down, I will put in another $100. And if the price moves further down, I will put in my last $100. This allows you to average down on the price you paid for the stock, and essentially you would have bought the stock for a cheaper price. Now let's say the stock takes off in the direction that you anticipate it to move the very next day after purchasing $100 worth of the stock. That's great, and you correctly predicted the move. However, this isn't always the case, so remember to avoid buying high with the anticipation that it will go higher. Instead, have a plan in place to take profits at a certain percentage level. My third rule is to buy the rumor and sell the news. This is in no way investing advice, but let's say Apple had a rumor that they were about to install the fastest chip in their phones that the world has ever seen. In this scenario, you could buy based on anticipation that they will release this new chip within the year. Then, when Apple makes an official announcement about the release of this new chip, then you could have a plan in place to sell your shares when the price moves up. My fourth rule is to stick to your plan. In future videos, I'll give you ideas on how to tailor your investing plan to your individual needs, but the most important thing is to never deviate from it. Let's say my investment plan tells me that I need to cut my losses at 10% and realize my profits at 50%. If the price drops by 10%, I'm out. No ifs, ands, or buts about it. And if the price increases by 50%, I'm out and I realize my gains. What this boils down to is discipline, and the more disciplined you are in following your plan, the more successful you will be. So let's talk about how to get started with your brokerage account. There are a few different types of accounts, but I'll go over the most common. The first type is a standard taxable account. You'll be paying taxes on all of the gains that you make, and this type of account allows you to invest in ETFs, individual stocks, and mutual funds. Typically, you can deposit any amount of money for most brokerages, although some of them may require you to deposit a minimum amount of money. The other most popular account is one that is geared to your retirement. So think of your 401k, 403b, or Roth IRA. For some of these accounts, such as a Roth IRA, you can choose which stocks or ETFs you'd like to invest in, but other accounts will include a portfolio of stocks such as a real estate fund, a tech fund, an emerging markets fund. Oftentimes, these accounts will have contribution limits such as $6,000 yearly for a Roth IRA, but these accounts do carry tax benefits. For example, contributing to a 401k will help to reduce the amount of taxes you pay since this money is taken out of your pre-tax income. However, you will have to pay taxes on this money once you decide to take it out of the account. A Roth IRA, on the other hand, will be funded by money that you have paid taxes on already, but you will not pay taxes if you withdraw money from that account after the age of 59. Retirement accounts, speaking from a tax point of view, are highly advantageous since you only pay taxes once, as opposed to a standard taxable account that is funded by money you paid taxes on, and once you make profits, you'll have to pay taxes on again. It's important for you to think about what your plan is and open your brokerage accounts accordingly based on whether you want to have an ability to trade and withdraw your money immediately, or whether you just want your money to sit in an account while not having the option to withdraw it until retirement. Personally, I contribute to a 403b with my day job while maxing out my Roth IRA and contributing a certain percentage of every paycheck to my standard taxable accounts. Now I'll walk you through a few different standard brokerage accounts and which ones I personally prefer, as well as some of the requirements that each one of them may have. I won't be talking about setting up a retirement account in this video since many can be done automatically with your employer. But if you'd like me to go in depth on my favorite Roth IRA broker in a future video, please let me know down in the comments below. So when opening a standard account, there are tons of options out there. Some of the most popular are Robinhood, my personal favorite for beginners, Webull, E-Trade, and TD Ameritrade. trade. Robinhood also comes with an added bonus of getting a free stock when you sign up, and in fact, if you click on the link in the description below, you'll be able to claim your free stock when you sign up. You'll also be helping to support the channel, as I'll be getting a free stock as well, so I want to thank you in advance for doing so. Robinhood and Webull also do not require you to deposit a minimum amount of money, so you can put in as much or as little as you'd prefer. Each of the brokerages mentioned above can be accessed both on a desktop or on your phone, which makes it extremely convenient. The only kicker is that you have to be at least 18 years old to open one of these accounts. If you decide to open a Robinhood account today, go ahead and get started by clicking on the link in the description below. The application won't take more than 15 minutes, but will require your personal information. They'll ask you to submit your full name, date of birth, address, social security number, and will have measures in place to verify your identity. Once your application is approved, then you'll need to have your bank's routing number and your bank's account number on hand to fund your account. Specify how much you want to deposit, and some of these brokerages have maximum deposit amounts for a specified length of time, and you're ready to buy your first stock today. Remember when I showed you the graph for the S&P 500 and how over the past 90 years it has had a major upward trajectory, albeit with several corrections and market crashes? Well, I want to introduce you to an index fund called the VU, which is my favorite index fund that is composed of all the companies in the S&P 500. Since this fund is used as an indicator for the economy, you can look at investing in the S&P 500 as investing in the US economy, especially if you believe in its continued upward trajectory. It offers high potential for investment growth, although it is riskier. It's a great pick for those of you who want a really safe pick and who are willing to hold shares of this fund for the long term. In this chart, we can see that an initial investment of $10,000 in 2011 would have turned into $45,000 in 2021. This is an amazing return, especially considering that this initial investment grew passively without any action on your part. This example shows the power of investing and why the stock market is one of those unique areas to make lots of money with just a little knowledge. So now that you set up your brokerage account, it's time to do your research. There are many YouTubers who have good stock recommendations, but smart money tells you not to follow any recommendation blindly. Just as you wouldn't buy a house without pre-purchase inspections, you wouldn't want to buy shares of a company without assessing it first. You're going to have to research not only the balance sheets of these companies to determine if they are a solid company to invest in, but you also have to look at the charts to determine where a stock is headed. In the following section, I'll give a brief overview on how I do fundamental analysis and the 5 things I look for when looking at the numbers for a company. I'll keep it simple and to the point here, since this is an introductory video to the stock market, and after you have studied up some more and are ready to go more in depth, click on the link above where I'll show you how to go about assessing a company just like the pros. Now, there are plenty of resources that you can use to research a company, but some of my favorites are Bar Chart and Yahoo Finance. One of the first things I'll look for on the balance sheet is the total equity, or the difference between assets and liabilities. This is a good measurement of the financial health of a company. What I like to see is that the total equity is increasing over the years. PB ratio compares the market value of the stock, or how much it is currently trading for, to the book value of the stock. The market value of the stock is the share price multiplied by the number of outstanding shares. The book value is the difference between total assets and liabilities. The PB ratio is calculated by dividing the book value per share by the market value per share. When looking at investing in a company long term, it's helpful to look for a PB ratio of less than 10. This indicates that it's a value stock and has a lot of upside potential. Let's look at Tesla with a PB ratio of 27.1 and Facebook with a PB ratio of 7.24. Which do you think will have a better long-term growth potential? In this scenario, if I was a long-term investor and my goal was to hold shares long-term, perhaps in my retirement account, I'd buy Facebook. A company's beta relates to its volatility in the markets, and a value of less than 1 indicates that it is less volatile than the market, while beta of greater than 1 indicates that it is more volatile than the market. Typically, your high beta stocks will be riskier while also giving you a greater chance of returns, while a low beta stock will be safer but will yield less returns. Net income is the revenue minus expenses such as operating expenses and debt. It is important because it takes into account their profitability while looking at costs from all aspects of the business. Institutional ownership is one of my favorite metrics to look for when conducting fundamental analysis, as it shows what percentage of shares the institutions own in the company. Institutions include mutual funds, insurance companies, and investment firms. These institutions conduct oftentimes expensive financial research into a company before investing a large sum of money in it. This is great for you, the retail investor, because it shows a good deal of faith that institutions have in the company, and the higher the institutional ownership, the better. I typically look to invest long-term in companies with an institutional ownership above 70%. The most well-rounded traders use a combination of fundamental and technical analysis. So what is technical analysis? It is used to predict price movements by using historical data. Technical analysis is more advanced, so I'll just cover it briefly, but when you're ready to learn more about how you can chart, then head on over to my channel where I'll go over different ways to predict where price action will go using chart patterns and indicators. One example of using historical data to predict price movements is support and resistance lines. For example, if the price of stock A has historically dropped down to $5 and bounced up from there, $5 can be considered an area of support, so if you see the price of the stock approaching $5 today, you could potentially use that as an opportunity to buy shares. Some indicators that I will use include the 5, 20, 500, and 200 EMA, RSI, MACD, and Bollinger Bands. I'm going to link my EMA strategy video here, but in the near future, I'll do a series of videos that break down more of my favorite indicators and how you can use this to predict market movement. For now, I recommend creating a free account with TradingView, or you can use Thinkorswim if you have an account with TD Ameritrade. Now let's talk about prospecting and how it's important when looking for what company or industry might be the next big thing. Sometimes there are industries where it is hard to predict where they are going just based on technical and fundamental analysis. This is when prospecting comes in. Typically, I'll spend a few hours every month looking at rumors related to emerging industries and doing research on particular stocks that are most promising. One current industry that I see being extremely prominent in the next 5 to 10 years are drones. Some of these companies can be found for just a few dollars. With rumors of several large corporations incorporating drones as a part of their delivery fleets, this could be a prime example of buy the rumor and sell the news. So while prospecting can be a very fickle game, it can also provide massive returns in the future. Think of a prospector 10 years ago who was looking at the concept of an electric vehicle and who was an early investor in Tesla. Now, I'm not saying that you should put all of your money into prospective companies, but you should allocate a portion of your money that you're willing to lose towards these riskier investments. I'm more of a risk taker, so I have roughly 20% of my money tied up in prospective companies, but I'm also fine if all those companies go bankrupt and I lose all of my money, since the majority of it is tied up in proven companies with strong fundamentals. So I want you to come up with a number or a percentage that you'd like to set aside for prospecting, and I don't recommend this figure being more than 20%. Alright, so now I'm going to walk you guys through how to buy and sell shares of stock on Robinhood. So I'm going to come to this magnifying glass option right here, and up in here where it says search companies, I'll type in the company that I want to buy, and that's going to be Context Logic or ticker symbol WISH. So here I'm going to click on trade, and some of you may not have the trade button, it may just say buy. Because my account is upgraded, I can have the option to either trade options or just to buy shares of stock. For our purposes, we're just going to go ahead and click buy here, and we're going to enter a number of shares that we want to buy. So we'll put 1. We're going to hit review and swipe up. I'm not going to buy it. It's after hours, but that's exactly how you buy an order. Now let's look at how we can sell a share of stock. So coming over here, I have this ticker symbol XSPA. It's a COVID testing company. So what I'm going to do is when I want to go to sell, I'm going to hit trade and sell. And like I told you already, not all of you are going to have the option to trade options. So you can just go ahead and click this sell button. And I only have purchased one option contract, so it will look this exact same if you have shares. So specify the number of shares that you want to sell, and it's right up here at the top right hand corner, and then hit review and then swipe up to sell. That's it. So how much money should you allocate to the stock market? This is one of the most common questions that I've gotten, and rightfully so. While I can't give you an exact figure, a general rule of thumb is to invest money that you are okay losing. If you have excess cash sitting around, I highly recommend setting up an account after this video. It will help you to get the ball rolling and get you over that initial hump of whether or not you should let go of that money to put it into the markets. I recommend setting a goal of how much you will contribute to an investment account every month. Make sure that you account for all of your basic needs and aren't using money that would otherwise be put towards your wife, kids, or dog. Another amazing rule of thumb that I like to use is that if I plan on buying a luxury item or an item that I don't need, then I will make sure to put that exact amount into my brokerage account. So if I want to buy a $2,000 Louis Vuitton bag, I'll first put $2,000 in my account and then go buy the bag. So let's talk about the tax implications when you go to sell a stock. In general, you will pay more taxes if you sell for profit within 1 year as opposed to selling it after 1 year. The profits you make if you sell a stock for profit within a year are called short-term capital gains. You'll be taxed based on your ordinary income. However, long-term capital gains or profit made when selling a stock after holding it for over 1 year are substantially less. This is still income dependent, but rates can vary from 0, 15, or 20%. Based on these two charts, let's say that you file as a single person and make $100,000 per year. Your long-term gains will be taxed at a rate of 15% compared to 24% for short-term gains. So if you'd like to support the channel and don't have a brokerage account with Robinhood yet, go ahead and click on the link in the description below. You'll get a free stock and I will too. Make sure to fund your account and then pick a few stocks and study up on them before buying. Anyways, if you like this video, please like and subscribe to the channel for more videos like this. I make weekly content related to trading, investing, and the stock market in general. My goal is to help and give you as much value as I can, so let me know down in the comments below if this helped you and what topics you'd like me to cover in future videos. As always, thanks for watching this video and I'll see you all in the next one. Peace!